You're very welcome to this pre-scene analysis. Over the next few hours, I'm going to be talking you through the main points in the SEMA pre-scene for February 2018 for the strategic level, and I'm going to walk you through each page of this pre-scene document, highlighting the main issues and what is likely to come up on exam day based on what we see in this document. So this particular case is based on the fictional company of Royals Gyms. When you turn to page 2 of the document, in the introductory section, you're told that you're a senior manager working in the finance team of Royals Gyms, and we'll refer to Royals Gyms as Royals for short from now on. You actually report directly into the CFO, the Chief Financial Officer, and your role is going to include advice on special projects and strategic matters. So let's just reflect on your role in this pre-scene. As is usually the case for the strategic level, you're quite high up the hierarchy at this stage, and as a senior manager, you will be expected to take more of a strategic view of the company. So that means your focus is actually going to be a little bit more on the long term. At the management level, you were thinking more about the midterm, and at the operational level, you were really just dealing with day-to-day issues. But at this level, you're expected to take the long-term view. You're also expected to make better use of people and leadership skills. You may recall, for example, at operational level, the technical skills accounted for about 64% of the marks assigned, but at the strategic level, there is an even split between people, leadership, technical and business skills. So because you're expected to demonstrate these people and leadership skills to a greater extent than you were at the management and operational levels, it means that you will be interacting with different kinds of colleagues. Whereas at the operational level, you were primarily dealing with finance colleagues, so you could keep the jargon quite technical. Well, at the strategic level, you're going to be interacting with a broader range of colleagues from different departments, different levels, and in particular, you're going to have to influence people very high up the food chain. You've been told here you're directly reporting to the CFO. You can probably expect triggers on exam day, though, coming from the CEO himself, even the chairman, the non-executive chairperson, and other very senior colleagues. So you'll be expected to influence them. And you're also expected to take a wider view of the business and the environment in which the business operates. So you're not just fixated on your own little department, your own little team. Instead, you need to think about the repercussions of your recommendations for the business and consider the competitive environment that the business is working in, but also the wider community that the business is a part of and how it relates to the community in terms of corporate social responsibility and being a good corporate citizen, and also to consider, for example, government forces and how they're positioned in terms of their power, in terms of their interest in the company, how they might impact on the moves you're looking to make. And at this level as well, when you think of your objective studies, E3, P3 and F3, there are a couple of things you need to think carefully of, and I would advise focusing your revision particularly on these key areas. With E3, it's all about recommending strategic options. With P3, often you're being asked to think of the risks, the strategic benefits and risks of a particular strategy that you're being asked to consider. And with F3, it's about finding adequate long-term funding for the projects you're implementing and developing a sufficient financial strategy to get behind those strategic decisions. So are you going to cut back on dividends to fund an expansion or an acquisition? Are you going to take on more long-term debt? Should you be looking to issue more shares. So you'll be expected in particular to weigh up considerations from those three key areas from your three objective subjects. Okay, so we've set the scene then in terms of your role and what is expected from you and some of the key areas you might want to revise from your objective studies. Let's look at the company background for this chain of gyms. So Royals is actually an unquoted company, and it was founded very recently in 2009 by two brothers, Marco and Frederick King, in the fictional country of Highlandia. Highlandia, we're told, is a well-developed economy and the currency is the H dollar. Okay, couple of things here. The fact that Royals is an unquoted company, for example. So it's a privately run company, and more than that, there is a strong family influence here. You have two brothers who founded the company together. As a private company, it is going to miss out on a funding option. It's not able to go to the markets and secure equity funding, is not able to issue shares. And there are also reputational benefits from being a stock exchange listed company that Royals will actually miss out on as well. And that's actually quite significant because later in the pre-scene we're going to see the importance of marketing and having a strong brand presence. This is a very, very competitive and an increasingly competitive landscape, and it's harder and harder for companies to stand out. And a company that is on the stock exchange is going to have a little bit more in the way of brand presence, and it's going to be more known than a privately run company. Having said that, there are positives as well to being a private company, and one of them is that you would avoid very onerous regulations and expectations. Coming from being a stock exchange listed company, so you don't have the same financial statement publication obligation. You don't have the same need to have your financial statements audited, and there isn't the same external pressure from big shareholders and big institutional investors, for example, that you might get as a public company. Okay, we know that Highlandia is a well-developed economy. We have no idea where exactly it's based. But as a well-developed economy, we can say that this will mean probably that the citizens of Highlandia have a little bit more in the way of disposable income. But on the other side, it means that certain costs are likely to be higher for Royals. The wage costs for employees are likely to be a little bit higher as well. So it might kind of even out in the end. Having said that, a company like Royals, which we will learn in a little while, is a budget company. It's a no-frills business, and it actually likes to keep its staffing numbers down. So it actually might be winning out here when you consider that their wage costs are not going to be a big part of their total costs. And they are going to be looking to get lots of volumes in terms of footfall, lots of people into the gyms. So the fact that their clientele might have a higher disposable income is going to be a positive for them. The H dollar is the currency in Highlandia. At the moment, we do not know if this company is trading in foreign markets. We'll find out later on, in fact, that they are not. But they are actually making some noises. They're leaving some hints in this pre-scene that they would actually consider expanding into other markets. So that would probably become more of a concern, the fact that they have their own currency, and there would be exchange rate risk introduced if they were to trade in other countries. At the moment, though, it's not such a big consideration. We're then told a little bit more about Frederick and Marco's backgrounds. Frederick, prior to the founding of Royals, he was running a very successful international property developed business, while Marco, his brother, had a profitable retail sportswear operation. And both have had a lifelong interest in sports and fitness. So it seems like they're a good fit for a gym chain. Both very interested in the area, and both have good business credentials, and actually they have relevant business experience, because property selection is very important for this brand of chains. Where their gyms are placed is going to be crucial in attracting enough people into the gym. And Marco, of course, in the sportswear area, he has an idea about what it is people are interested in when it comes to sporting activity. So Marco was actually the one, we were told, who experienced some frustration with the current gym offer in his home country. He was actually traveling a lot as a business executive in his previous role, and he found that there were lots of gyms offering 24 hours a day, 7 days a week, every day of the year, access to people who wanted to use their facilities, and there was no contractual obligation. And he considered that to be very interesting indeed, and thought, okay, there's an opportunity in my home market there. And what that means really is that if you set up a gym like this, what you're doing is you're lowering barriers for people to use your service. On the other hand, you also lower the barriers to exit. So this is actually a problem that we will see. While Royals has been very successful in attracting lots of people to its gyms, there is a suggestion throughout this pre-scene that they're having a little bit of trouble retaining those people. It's kind of easy come, easy go. If you make it very easy for people to come in, they don't need a contract, so they're not tied to any long-term agreement, well, they'll come in, they'll use your facilities for a little bit, and then something will come along that catches their eye, a rival that offers something similar, and they'll just jump ship very easily. There is no cost to them leaving your gym. So the offering made it very easy for Marco to maintain his training while he was working overseas, this 24-hour a day, 7-day a week, every day of the year access with no contractual commitment. And it made fitness very accessible and very flexible. And those two terms will come up a couple of times through this pre-scene. That's what they're aiming for, making it accessible to many, many groups of people, making fitness, access to these fitness facilities flexible as well, making sure that they're in a convenient location for the vast majority of people, and of course keeping the costs low too. So there was nothing like that in Highlandia a few years ago, until relatively recently, but the interest actually in health and fitness was really growing. And the thing is that the dominant forces in the marketplace were very high-priced gyms with restricted opening hours and long-term membership contracts. And there were a couple then of state-run fitness facilities, but they seemed to be quite limited as well. So it seems that the marketplace was ripe for disruption. The demand conditions were good. Interest was growing in health and fitness, and the available offer was highly priced and wasn't very flexible or very accessible. So together, the two brothers then opened the first two gyms in 2009 in the capital city of Highlandia. And their expansion has actually been absolutely rapid. We will see the pace of their growth in a little while. They're up to about 125 gyms or so now. They're growing by about 45% or more per year in terms of the number of gyms that they're opening and in terms of their revenue growth as well. So very aggressive growth being pursued by the two brothers. So Frederick, because of his knowledge of property development, he was able to actually locate two excellent properties. And because of Marco's previous experience, he struck a really good deal purchasing premium fitness equipment. And the initial investment was about $3 million, so not insignificant. That means that the barriers to entry for potential new entrants are not insignificant. So they split the share capital 50-50 right down the middle, issued 100,000 shares in 2009, and What this means, because the executives, the key executives in the business are also the key shareholders, it means that it's very likely that the senior executives are going to act in the best interests of the shareholders, because they themselves, of course, are the shareholders. In other words, there's no agency problem. That is a term you would have come across in your F3 studies, no doubt. It's where there's a disconnect between the people running the company and the people who actually own the company. And the people who run the company day to day, they act in their own interests, and that can be contrary to the interests of the owners of the business, the shareholders. This is not going to be the case here. So that is one positive of these two brothers running the company and being the chief shareholders. So Royals was launched with the aim to make gym-based fitness training highly accessible by removing those obstacles, the opening times and the contractual membership being done away with. And they wanted to make it very affordable to most people, open at all times, easily accessible by public transport. So as well as being located in good urban areas and quite visible, that's important as well for the brand perception and the knowledge of the brand. They wanted it to be easily accessible by public transport. Why might you say by public transport? Well, it could well be to attract lower income populations. There is maybe a tendency for those on lower incomes as students, those who have precarious employment situations or are unemployed, or younger people, etc., for them to not have their own means of transport. So they might want to be taking public transport instead. And this is a business model based on keeping costs low and charging low prices. So they're going to be looking to attract lower income groups in general, as well as people on middle incomes and higher as well. They're not discounting those people either. And the fact as well that they should be easily accessible by public transport probably means they're going to be in urban areas, and those areas have dense populations. With a low-cost model, it's all about getting volumes in. You want traffic, you want lots of footfall in your gyms, because your margins are going to be quite low relative to the high-priced gyms. Then you're going to want to make up your revenues with high volumes, and that's what they're trying to do with this business model. So we're told for the first time, even though the signals are clear in this opening section, that Royals is operating as a budget gym. High quality, affordable, but no frills. Okay, and it's interesting that they use that term, high quality. There's often a perception with budget that the quality is necessarily low. And actually, that isn't always the case. You think of some of the other industries that have actually been disrupted by the no frills approach. Airlines being a famous one. You have companies like Ryanair and EasyJet that operate low cost and low price models, no frills. Now, Ryanair gets a lot of bad press because you would not say that the quality is particularly good there. But actually, there are some new entrants that are continuing to disrupt the airline industry, such as Norwegian, and they're operating transatlantic flights, a little bit higher quality, even though it's a kind of a no frills approach as well. And they're proving that maybe you can actually get both to a certain extent. You can offer something that's very affordable, but you don't have to compromise hugely on quality, at least. In the area of fashion, you have a company like Zara, which is famously, has disrupted the fashion industry in copying the styles of high fashion. And it has implemented a sort of a low price and low cost model. The quality is not terrible at all there, you would say. So they've managed to pull off that approach as well. They're affordable, but not bad quality. And indeed, supermarkets as well, like Lidl and Aldi, manage to maintain a decent level of quality while also offering something that is very, very affordable. So the gyms, we're told, are very popular currently in Highlandia, and total membership and new gym openings have been growing rapidly since 2009. Think of a model like Porter's generic strategies. Certainly, Royals is adhering to the cost leadership part of that, of those generic strategies. Remember that you could be differentiated, or you could have a broad or a narrow focus, and certainly I think Royals is going for a broad cost leader focus. And it's interesting that Royals thinks of all of its customers as members. It uses that term. I think that's actually quite clever, because what that does, even if these are people that are using the gym on a one-off basis, that creates a sense of belonging. And what they're trying to do there is to create a connection so that it's less likely that the newcomer leaves. They're being referred to as members instead of just customers. So they're trying to make it less of a transactional thing, less of a one-time thing. They're trying to establish a link and to maintain that link with something that they want to be a longer-term arrangement. And here you have an indication as to just how much they have been growing. Very aggressive growth, as I said. The first few years, it was conservative enough, but really it's since about 2013 that growth has just taken off. And in 2009, they started with 2 gyms, and in 2017, they already have 125 gyms. So that is growth at a multiple of 62 times. Very, very significant growth. And it's also interesting to look at the average number of members per gym, because that has actually declined quite a lot. You had an average of 4,502 members per gym in 2009 when they opened up, and that has dropped to 3,514 members in 2017 per gym. So you have falling average members, and I think that's a sign of rising competition. We're going to see that the space, the budget sector of this health and fitness facility industry is becoming quite crowded, and there are lots of new entrants. And if they're all just differentiating themselves on price, they're not really differentiating themselves. That's just it's their hook. They have to keep prices low. Well, it's easy to get into a bit of a price war. And if all you have is price, well, then you're not going to remain distinctive for too long, because it can be quite easily copied. So I think that's been happening in the recent times. Having said that, over 2013 to about 2017, the drop-off in average members has not been that bad. It was really more between 2009 and 2013 that the average members per gym started to fall. So we're told that there have been no dividends paid out since 2009. So Marco and Frederick have actually been very disciplined in that sense. They're not taking anything out of their business. They've been reinvesting all of their internally generated profits into new gym openings, and that has been their financing decision. Think of F3-year studies there. Having said that, in 2012 they decided to look for outside investment, and a venture capital firm called GEM decided to invest $8 million dollars, of which $2 million was a loan note and $6 million was for 67,000 shares, which gave them a 40% stake. So what happened was there was a little bit of a trade-off. The two brothers decided, okay, we're going to lose some control in exchange for faster growth. We don't want to just rely on internal funding anymore for our expansion. We are going to take some outside investment to more rapidly expand. And that has certainly been the case. If you look from 2012 onwards, that's when the really aggressive growth started up. And it's not a coincidence that coincided with GEM's investment. So very importantly as well, a key part of the deal was that GEM was able to negotiate on behalf of Royals access to a credit facility with the bank of $45 million dollars. So adding that to the $8 million that GEM invested themselves, it gave them the Royals Gym gyms access to 53 million for growth. Very, very significant. And as a stipulation, as a part of the deal, GEM wanted 2 non-executive directors to be placed on the board of Royals. So you would presume they're representing the interests of GEM and keeping an eye on how the company is being run. Now, presumably, GEM is looking for some kind of a return on their initial investment. Now, if dividends are not being paid out, that means obviously that the investors are not getting a return in the form of dividends. So they've got to be looking at capital growth in some way. They're also not a stock exchange listed company, so they're not seeing a share price appreciation. So you ask the question, what is GEM's end goal here? Are they looking for an initial public offering in a couple of years so that they can cash in, sell their shares when the company is listed on the stock exchange and make off with a return in that way? Are they maybe looking or open to the possibility of selling to another venture capital firm or another private equity firm in the future? Would they be open, for example, to a management buyout? So that's worth considering. That could come up on exam day. You're asked about future financing. Do you want to list on the stock exchange or something like that? You'll have to consider as well that at least one of the brothers is very close to retirement age. The CEO of the company is 63 years old. And in a couple of years, you would imagine he will be looking to retire and maybe would be willing to cash in on his shares as well. So the idea with venture capital, just to remind you of the distinction between a venture capital firm and a private equity firm. Private equity typically would look to take 100% of the shares in a company, and if it's on the stock exchange, they would delist it and take it private for a few years, and strip out some of the unnecessary costs, and look then to maybe list again in a few years' time. With a venture capital firm, often they'll take a lesser stake, as has been the case here with GEM taking 40% of the shares. And venture capital firms are typically looking for very high growth opportunities with very high returns attached. And certainly this business has been very high growth in terms of its revenue growth, in terms of the number of new gyms it's been opening. And as I said, watch out for the kind of return that GEM is going to get eventually from this. How are they going to extract a return from this business eventually? And the credit facility is very, very important for this company. If 45 million credit facility with the bank. Is that an overdraft facility? If it is, that means that the bank could actually withdraw that facility at very short notice. And that makes me a little bit nervous at this early stage, because it means with such rapid expansion, and if they're relying on the access to this credit facility, that if it was withdrawn, the growth would stop. It would dry up from one day to the next, and the company might be in big trouble. Okay, so obviously GEM is going to have very high interest and have very high power. In other words, they're a key player according to Mendelow's matrix. So they need to be very well managed and very well informed of all of the key moves the company is making. I would just ask you to reflect as well on your E3 studies, and when you think of the strategic success of the company. And of course, as a senior manager, you will be asked to think of the strategic success of your company. And often a company achieves strategic success by way either of a resource-based view of the firm, or alternatively by positioning itself well. With a resource-based view of a firm, you would rely on a better product or a better service, and great resources in the form of the people you have, the IT, superior IT, a superior brand, access to financing that your competitors mightn't have. And I think that would be more the case with luxury gyms that we will talk a little bit more about soon, the higher priced gyms. Then if you're taking a positioning perspective, it's all about being flexible in relationship to your environment and adapting to customer needs. And I think that fits more with what Royals is trying to do. Moving on then, and we see the next section deals with the health and fitness club industry in Highlandia. And what we're told is that annual membership has increased in 2009 from 3.2 million to almost 4.5 million by the end of 2017. In other words, that market has grown by about 41% in that period. So that's quite healthy growth. Highlandia has got a population of about 32 million, so a reasonably big country. Having said that, that population has been stable for about 10 years, so that's quite significant. So once market growth peaks for the budget gyms, where will the growth come from? Once the percentage of the population that attends the gym, we'll talk about that more in a minute, but once that peaks, and once the budget gyms have won as much of a share of the marketplace as they're going to win, then growth will stop for those gyms. And maybe they need to start looking outside of Highlandia then, unless the population starts to grow. And we're told that the reason for the growing interest in health and fitness is due to a couple of factors. First of all, there's an increased customer awareness of the benefits of an active lifestyle, and government initiatives to promote the health and fitness industry and health and fitness in general in Highlandia have been underway over the last few years. And we'll see that the government is a reasonably influential stakeholder in this particular market, in that they encourage people to get into the gyms. There's an article towards the end of the pre-scene talking about the Ministry of Health and how they're trying to encourage the population to be more active. And they're looking, in fact, for private sector partners to promote those activities as well. That's an opportunity for a gym like Royals. And in the past, a number of people have actually been deterred from joining clubs due to the high cost of membership, and also due to the fact that they needed to sign very long-term contracts, and the locations were not very convenient, and the opening times were not convenient either. So these are all the inconveniences that Royals is fighting against. And there were some state-funded gyms. They may have been cheaper, for example, but they represent only 5% of the total number of gyms in the marketplace. So discounting the state-funded gyms, the split between gyms is between the traditional providers and newer budget gym operators like Royals. With the traditional gyms, you had to sign a fixed-term contract over the course of 6 months or a year, and if you wanted to leave early, you would have to pay an early termination fee. When you think of the number of people around this time of year, for example, right after the Christmas, when they have their very good intentions and they are committing to New Year's resolutions, they want to join gyms, and often people will go along, pay a yearly membership, and by the middle of January they're fed up with it. They've already committed some high sunk costs in the form of a 1-year membership, and that is hugely frustrating. Obviously, you can see the appeal of a budget gym that offers the client the possibility to just come and go whenever they see, whenever they want to, and they don't lock them into longer term agreements. Of course, the traditional gyms have the advantage of securing revenues early on in the year. In January, when people race to the gyms with good intentions, they're locking in yearly fees very early on. They know well that a lot of those people are not going to come back very much. So these gyms, the traditional gyms, they are generally larger. They have a wider range of facilities like swimming pools and saunas. And because of that, they have higher operating costs, and they also tend to have a higher staff count because they offer a more personalized service. These gym staff, they're devising training programs for their clients, offering personalized feedback, and generally keeping an eye on things as people come to the gym to use them. So they've lower volumes in general, these gyms, but they set higher prices. With the budget gyms, then, on the other hand, there is no contractual obligation. They have a much more stripped down offer. They have core fitness equipment. They have basic cardiovascular equipment, resistance training machines, and free weights. And it's very easy to sign up. It's very easy to cancel. and they have longer opening hours for convenience, and they have better locations in city centres, more convenient, accessible by public transport, as we were told before. So it's no frills. They want higher volumes in terms of the number of people using the gym, and they set lower prices. So over the last 10 years, there has been a gradual shift towards the budget providers and away from traditional providers. And we see that in the table underneath. And this kind of shift has been witnessed as well in the airline industries and indeed with the supermarkets that I was talking about earlier on. People are moving away from traditional higher cost providers to more no frills providers, especially when the no frills providers provide something with a minimal quality guaranteed. It's very different if you're changing to a lower cost provider if the quality is terrible, but if actually the quality is quite acceptable, then many people are happy to avail of it, and people have been voting with their wallets over the last number of years. So look at that table. First of all, it's important to note that the percentage of the Highlandia population that's become more active in recent years as members of gyms has been rising all the time. It's gone from 10% in 2009, it's forecast to be 16% in 2018. And the indication later on in the pre-scene, in one of the last articles of the pre-scene, is that it's going to grow, to keep growing. The more advanced countries, we were told, are at about 18%. So we've reason to believe that that will keep moving upwards, and that's a positive development for gym providers. And so that means that the total members has risen from 3.2 million in 2009 to just over 5 million is the forecast for 2018. And then the last two rows of this table show the split between traditional gyms and budget gyms, and it's gone from being almost completely dominated by traditional providers to being a 50-50 split forecast for 2018. And one would imagine that it's going to flip in favor of budget gyms out into the future. So they're very positive developments for a company like Royals. So it's a case of a rising tide lifting the Royals boat. There's a growth of the budget sector in general, led by Royals, admittedly, plus allied to that is a more fitness conscious population. So two rising tides there lifting the Royals boat. But the split will eventually stabilise between traditional and budget providers, one would imagine. There will always be people, for example, who'll want the fuller offer given by the traditional gyms, and eventually the percentage of the population using gyms will stabilise too. It might hit 18%, and what happens then? Well, it might be worth looking at other markets if and when that happens. With the operations then on the next page for Royals, we're told that Royals wants accessible facilities and convenient locations at affordable prices and no contractual membership commitment. So we've heard that a couple of times already. The buildings that it uses are located outside of main city centres in old warehouses, so they're big spaces where rental prices are quite low and property choices are plentiful. So if there's a big supply of properties like this, then of course the prices are going to be lower, and they need to keep their costs low if they're going to be able to support a lower price. And access at the same time to these facilities by way of public transport is very, very important. What it also means as well, by providing public transport, and if most of the people are arriving in public transport, is that there's no need to provide parking facilities, which can be costly too. Often you find that pricier gyms are located in hotels because they make use of the parking facilities there too. During the fit out of the gyms, Royals rigorously manages its costs, so it's aggressively looking to keep its costs down. And the high quality fittings that it uses, even though they are high quality, they are simple and they operate an open plan type structure, and they have basic locker rooms. So What that means is that they've less furnishings and it simplifies the construction of these gyms. I would say as well that it does seem to be important even for budget providers to obtain a certain level of quality. If they fall below that, people are just not willing to use the service, however low the price. So people, I think in general, consumers have become more demanding in recent years. They expect a minimum of quality. So it's important that Royals achieves that minimum of quality. So they actually work with the premium equipment provider Topkit. And the reason they can do that is because they've opened so many gyms that they can achieve significant discounts because they're buying in bulk. So they're buying up, treadmills, not for one gym. They're buying up treadmills for 5-10 gyms at a time. And that allows them to get this high quality equipment at a discount. And each gym, we're told, contains about 100 pieces of exercise equipment. We have a little picture there of some cardiovascular equipment. So the gyms are decked out with running machines, exercise bikes, rowing machines, cross trainers, and they have then for resistance training a mixture of free weights and machines. So they're kind of standard features of any gym that you might expect. What they're not providing is, classes that are overseen by instructors. They're not providing swimming pools and saunas and things like that. They're more features found at higher priced premium gyms. We're told that there are vending machines on site, and that is a nice form of ancillary revenue. So those vending machines might often sell things like protein powders and protein drinks, for example, after the workout is finished, and they can be quite highly priced, in fact. So that's a nice form of ancillary revenue for the gym. And in fact, even some budget gyms, in fact, my own gym charges for the use of their showers. So you pay a rate of about €20 per month, very low price. You access the gym, but then to shower on at the gym facilities, you have to pay 50 cents per shower. So that is, I think, a very sneaky way to get some ancillary revenues and pushes up the overall cost without for the member, without the member actually really realizing. So to promote the flexibility of the gym facility, members can stop using the gym at any time. So they're not being asked to commit to a long-term contractual period. Most people, however, do sign up to monthly direct debit payments of about $15 And other members, were told, actually operate or use the gym on a pay-as-you-use basis. Now, when you do get people to sign up for the monthly direct debit payments, it's a little bit of a hassle. Of course, there's no long-term contractual commitment, but because it's a little bit of a hassle, it means that there is a little bit of a barrier, a little bit of an incentive to stay put. So that is important. If they can push more people to sign up to the monthly direct debit payments, it will avoid then maybe lots of people abandoning the gym too easily. If everyone is using the gym on a pay-as-you-go day-to-day basis, then they're far more footloose. They're likely to just, run off to the next, to the newest budget gym when it opens up. And with the pay-as-you-use members, maybe the gym wants to think about ways to try to phase this out, because those people, as I said, are more likely to jump ship when something else comes along. When you think about, there's a little bit of a parallel here in terms of signing up and, signing off on a piece of paper, that you set up some direct debit payments. When you join, there's old statistic that's often quoted that people are more likely to get divorced than to change banks. You think of, when you start up, when you open your bank account, you have to sign up, sign a few forms. It's not an overly laborious process, but the very fact that you have to sign a few forms, you have to spend a little bit of time reading the fine print, etc., means that there is a disincentive to just switch banks very easily. So just a very, very small barrier like this can create an incentive for people to stay put. So the venues we know are open all times, 24 hours a day, 7 days a week, 365 days a year. Staffing levels are low. That's crucial. You keep your operational costs down in that way. There are 3 full-time equivalent members of staff on average per site. And when you think that there are about 3,500 members in the gym, it isn't really a very high number of employees per gym. Actually, that can create risks, and we'll talk about those risks later on. With the property management then, we are told that there's a rigorous property selection and there's a target return on capital. So it's a challenge, I would say, to maintain a rigorous selection when you're opening so many new gyms. So they need to make sure that they adhere to that rigorous property selection as they grow. And we know that these gyms have to be accessible by public transport because the areas need to be large enough to accommodate a high volume of members coming through. So generally you'd expect them to be in urban areas. And they want to secure competitive terms with the landlords. We do know that they're slightly outside main city centres in old warehouses, and there are lots of options to choose. So that would give them negotiating power. And they generally lease the premises for 15 years and the rentals are paid up front. So there are large upfront payments perhaps coming out. And they need access to sizable local populations, and that's taken care of by the fact that they're operating in urban areas.